Next housing market crash worse than 2008. Is it true that a crash worse than the 2008 crisis is predicted for commercial real estate? Could this prediction materialize in 2023? Are business earnings expected to decline in comparison to previous years? What are the underlying reasons for these potential challenges? Has anyone made these predictions? In this video, we will explore these subjects in depth to gain a thorough understanding. Without any further delay, let's dive into the video. According to a recent report by Morgan Stanley, the commercial real estate sector is predicted to experience an economic crash that could surpass the severity of the 2008 financial crisis. What sets today apart from the 2008 housing market crash? The housing market today differs from the 2008 housing crash due to stricter lending standards, predominantly fixed-rate mortgages, and higher homeowner equity. Lessons learned and regulations enacted after the crisis have reduced the risk of mortgage defaults. Unlike the past reliance on adjustable-rate mortgages, most borrowers now have fixed-rate mortgages, shielding them from payment shocks caused by interest rate resets. Additionally, a great number of homeowners have equity in their homes, providing a cushion against economic downturns. These factors contribute to a more stable and resilient housing market compared to the conditions preceding the 2008 crisis. What implications would a recession have on the housing market? According to the National Bureau of Economic Research, a recession is characterized by a substantial and widespread decline in economic activity over a prolonged period. Economists monitor various indicators to identify the onset or presence of a recession, including consecutive quarters of GDP contraction, high inflation and borrowing costs affecting spending, slowdown in manufacturing and trade sales, increasing job losses, rising unemployment rates. Another significant signal is an inverted yield curve between long-term and short-term bonds. Lisa Shallett, the Chief Investment Officer for Morgan Stanley Wealth Management, highlighted the challenges faced by commercial real estate, including the impact of hybrid and remote work trends, as well as the need to refinance a significant portion of mortgage debt within the next 2 years. Analysts are anticipating a decline in the commercial real estate market that could be up to 40% worse than during the Great Financial Crisis, presenting a substantial hurdle for the industry. Worries have been increasing that the commercial real estate sector might face major problems following the recent issues in the banking industry. People are concerned that rising interest rates will continue to negatively impact different markets. The commercial real estate industry has already suffered significant damage as a result of the COVID-19 pandemic. When the virus started spreading in spring of 2020, many offices had to close to prevent its spread. Even after restrictions were lifted and offices reopened, not all employees returned to in-person work, resulting in many buildings remaining empty. According to Shallett, office vacancy rates have reached a level not seen in the past 20 years. The rise of remote work has led to a permanent change in occupancy rates for the commercial real estate sector, as stated by Amy Yanatosh Purnanandam, an economist and banking risk expert at the University of Michigan, in an interview with Newsweek. The decision to raise interest rates intended to control inflation has made it more expensive for people to buy and refinance projects. In the past year, the Federal Reserve has significantly increased borrowing costs, which is the biggest increase since the 1980s. Interest rates have gone up from almost zero to over 4.75%. The collapse of Silicon Valley Bank in March and its aftermath have further strained the commercial real estate market. Banks are now more hesitant to lend money because they worry about potential defaults. They fear if depositors withdraw their funds all at once, the banks won't be able to fulfill their loan obligations. According to Robert Hockett, a financial regulation expert at Cornell University, banks with a substantial number of commercial real estate loans in their portfolios are anticipated to encounter difficulties in the near future. This sentiment aligns with the concerns expressed by Tesla CEO Elon Musk, who recently tweeted that commercial real estate debt is the most pressing issue. Musk's warning was prompted by a tweet from the Kobeshi Letter, a weekly commentary on global capital markets. The tweet highlighted that over the next 5 years, more than $2.4 trillion of debt in the commercial real estate sector will mature, surpassing any previous 5-year period in history. Both Lisa Shallett and the Kobeshi Letter emphasized the considerable risk that declining commercial real estate prices would pose to small and medium-sized banks, as they hold a significant percentage of new loans ranging from 70 to 80%. And that's all. As we conclude our discussion on the implications of a recession on the housing market, we hope you found the information valuable. What are your thoughts about this? Must share with us in the comment section.